Welcome back to part 3 of the Independent Investor. For this week I was talking about Kinder Morgan, gasoline company I purchased last week. And I did say earlier in the last decade, or this decade, they had over-purchased some assets, and they kind of got taken out to the woodshed for that. Had to write down some of those assets, and it came all the way down from 44 down to in the $14 range. But since that time, it's been trading between 14 and 21. Again, I bought it for, like I said, the dividend, and just things seem to be turning around for the company as far as their debt levels and everything else. And just these companies too, basically are turning into monopolies. So your TransCanada Pipeline, your Kinder Morgans, your Pembina, your IPLs, it's just nobody can really set up this infrastructure anymore. There's just too much political things to deal with. Going through any Indian reserves or not in my backyard. We've got people now with greenhouse gases. They oppose any new pipelines. So these existing companies, I can't see how they cannot pay their dividends and increase their dividends, just because virtually there will be no new competition coming in. And it's a bit of a natural monopoly in that you're not going to build one pipeline next to another pipeline. It just would make no sense. So so one of the very rare areas where you can kind of get a natural monopoly. Again, with the size of Kinder Morgan, it ships 40% of all U.S. gas in the United States, and that consists of roughly 70,000 miles of pipeline. I think that's up with TransCanada. I think TransCanada Pipeline has about 80,000. And it's just not natural gas. The natural gas liquids, like carbon dioxide, and then just plain natural gas. So, ironically, Kinder Morgan was originally started from assets acquired from Enron. If everybody old enough to remember Enron, when turned out to be a complete fraud, and they had to turned into financial collapse. I think it went from, I don't know, it was $100 billion basically was wiped out, but they ended up picking some of the assets from when that collapsed. So again, it's as I've mentioned, it's trying to grow organically now. That means trying to grow their assets from within their corporation versus buying other assets. So again, I feel their debt levels will be pretty conservative going forward. That's about it for, I think I mentioned too that they sold Pembina Pipeline shares. They received $800 million for that, which again went directly to paying down debt. So again, a little bit more conservative. As far as other trades and things I'm watching, I mentioned last week about Carnival Shipping, CCL. It's like you can, there's never a sure thing in the market. I like this company, I explained that last week, but then this week the coronavirus comes out of China. And what's the first thing that's going to affect, of course, is travel. And with Carnival Cruise Lines, the tourist industry, travel, it's one of the first ones to get hit. Let's pull up a chart. So you can see here, we're having a good run. I bought it down in here, ran up to 52. but it's given most of that back now. I really don't want to sell because I was kind of hoping this is a company I could keep for many years. But I'll just have to see how bad things get in China, and if it ends up getting a lot worse, then I'll probably be forced to sell this. I typically don't like taking too much of a loss on anything. I just, if I get to a 5 or 10% loss, I just basically get out, reassess the situation. Sometimes that works against you. You know, the stock turns just as you sell it, you feel like the world's against you. But that's just the market, so I've just learned to try not to take big losses. And the other company that, I'm not sure if I've mentioned in the past or not, is Baidu, which is here. This one I bought a bit too early, but I did add a few shares when it kind of leveled off down in the 100 area. It's basically the Google of China. I haven't done a lot of research, I haven't gone through all the numbers, but basically, to me, it's one of those companies that China is just not going to let fail. It's got the backing of the government, just like Google in the United States. We see things like Facebook get banned in China, and then Google kind of picks up on that. It's been increasing. It was more computer based, but now it's gone to more videos, a lot like YouTube. So that's been increasing their advertising revenues. I think the fair value by Morningstar is around 180, 170, 180, which is up in here. So again, but this is another one I'm going to have to watch because of the virus in China. I might be forced to sell it if things get too bad. I don't want to because it's a nice channel, just slowly going up. And if I got back up to the 180 area, I'd probably start doing covered calls on it for income because it doesn't pay a dividend, right? So another thing I'm doing, well, I have been doing for a while since I felt this market's been overvalued for a couple of years now. But I think it's a strategy when we finally do have a correction, is doing short puts on very expensive technology companies. And one company I did this on just last week, I've got about 50 to 100 of these that I kind of watch, and this one here is Paylocity. It's PCTY. If I go on the weekly, so if you look on the weekly, we can see this has gone from 20 bucks up to $140. And you see here it's gone a bit parabolic. That's usually the end of a run, but it's scary to do anything in that level because it can still move quite a bit more. So what I have done is, I'll go back to the daily charts. I've done a covered call, and I went all the way up to 165. And that's, I get $4.70, but what that means, if it goes above that, I have to, this isn't covered, so it is riskier. It's not like I have the shares to give to the other side of the trade. I'd have to provide the shares, which would leave me a short position at 165. But it's high enough up, and the volatility, which determines the premium, was still fairly high, and it looks like it did start to roll over here a little bit, and you can see from McDie it's at the highest it's kind of been, and usually rolls over at that price. So and the last few days you can see there's actually been net selling. So, and then I gave myself like a good margin So I think I should be okay. Again, I don't get greedy. I could put it down at 155, I could do something like that, but with these companies, you don't know. I've had some that actually did, I had to sell out at a loss or provide the shares, even when I thought the valuation was ridiculous. When I did the trade, this company, for example, has a price to share ratio of 15, which I said most companies are 2 to 3. P/E ratio is 133 earnings. Means it take 133 years of the current earnings to get your money back. Price to book is 23 times. Usually companies trade at 1 or 2, 3 times book value, right? And the growth is only is around 20%. It's not like 35, 40 like some of these companies are. So if you want to give a very, very optimistic valuation a year out, look at Yahoo's earnings. They're at $2.50. Give it a P ratio of 40. That's $100, and I'm way up there at 165. So, and that's just till this August. So it's not too long out. And Morningstar has a valuation of $87 on the company. So when the recession hits or turn down hits, I want to do more of these. That's why I've keep an eye out for all these. I put them on eSignal. I put alerts on them when they get to certain prices, like if they drop or if they even get higher. And then my strategy would be to